In 2019, a private equity firm called Vista Equity Partners sent a team of consultants into one of its software portfolio companies. Within 6 months, they had increased the company's revenue by 40%. The consultants did not bring new clients. They did not launch new products. They simply applied a standardized operational playbook that Vista had refined across dozens of previous acquisitions. That playbook is now being automated, and the implications for the $3 trillion private equity industry are more significant than anything the industry's own analysts are publicly discussing. Private equity is the most powerful financial force most people know almost nothing about. It owns more of the global economy than most people realize. Hospitals, software companies, retail chains, media properties, logistics networks, private equity firms control assets worth $3 trillion across every industry that touches daily life. And for decades, the model that built this empire operated on 3 structural advantages that its practitioners believed were permanently irreplaceable. Those 3 advantages are being systematically dismantled. By the end of this video, you will understand exactly how. You are going to understand why private equity's most valuable asset was never the capital it deployed. It was the information advantage it operated with. You are going to understand the 3 specific capabilities AI has developed that have made that information advantage available to operators outside the PE industry for the first time in history. And you are going to see what that structural opening means for the businesses, investors, and operators who recognize it early. The private equity playbook is being automated. The question is whether you are inside that automation or outside it. To understand why AI's impact on private equity is structurally different from its impact on any other financial industry, you need to understand what private equity actually does. PE firms raise capital from institutional investors, pension funds, university endowments, sovereign wealth funds, and deploy that capital to acquire companies, improve them operationally, and sell them at a profit within a defined time horizon of 3 to 7 years. The mechanism sounds simple, but the value creation that happens between acquisition and exit is where the industry's complexity and its structural advantage actually lives. When a private equity firm acquires a company, it is not making a passive investment. It is taking operational control. The firm's partners and operating advisors go inside the acquired business, diagnose what is structurally inefficient or underperforming, and apply a targeted improvement program. Cost reduction, revenue optimization, management restructuring, go-to-market improvement. The company that emerges from a well-executed PE ownership period is structurally different from the one that entered it. And the firm's ability to execute that transformation consistently across dozens of portfolio companies simultaneously is what separates the firms that generate exceptional returns from the ones that generate average ones. The modern private equity model was formalized in the 1970s and 1980s. Jerome Kohlberg, Henry Kravis, and George Roberts founded KKR in 1976, establishing the template the industry would follow for the next 5 decades. The core financial innovation was the leveraged buyout. Rather than acquiring companies with equity capital alone, PE firms used debt to amplify their purchasing power, borrowing against the acquired company's own assets to fund the acquisition. This financial engineering created returns that traditional equity investing could not match, and it created an industry that would eventually control trillions of dollars of global economic output. But financial engineering was only half the model. The other half, and the half that is more relevant to understanding AI's impact, was operational improvement. The best PE firms did not simply buy companies, load them with debt, and sell them. They bought companies, systematically improved their operations using proprietary playbooks developed across hundreds of transactions, and sold them as fundamentally better businesses. That operational function required 2 things that PE firms had, and most other investors did not. The first was proprietary data. The second was exclusive deal flow. Over decades of transactions, the best PE firms accumulated an unmatched data set of operational benchmarks. What a healthy software company's sales cycle should look like, what a well-run logistics network's cost structure should be, what a high-performing retail chain's inventory management should produce. This data was extraordinarily valuable because it was exclusive. No outside investor, no independent operator, no business owner could access it. It lived inside the firm. And alongside it, the deal flow. Access to acquisition opportunities that never reached the public market because the relationships to surface them required years of institutional trust building that no newcomer could replicate quickly. Together, these two advantages created a structural moat that protected PE returns for nearly 5 decades. The industry built an entire professional infrastructure around maintaining it, a class of analysts, associates, and vice presidents whose primary function was to gather, analyze, and apply this proprietary intelligence at scale. It was, in structural terms, almost identical to the information monopoly that protected Wall Street analysts, real estate agents, and management consultants before AI dismantled each of their moats in sequence. Private equity was simply the last domino standing, and between 2021 and 2024, the first domino pushed it. 3 AI capabilities crossed thresholds that made the private equity information moat structurally indefensible. The first was deal sourcing intelligence. AI systems trained on company financial data, market signals, ownership records, and operational metadata can now identify acquisition targets with a comprehensiveness no human deal team can match. Platforms have deployed AI sourcing tools that surface off-market opportunities at a scale that previously required a network of relationships built over decades. The relationship advantage is being replaced by a data advantage. And data, unlike relationships, does not take 20 years to build. The second threshold was due diligence automation. PE firms traditionally spent 8 to 12 weeks on due diligence for each acquisition, a process involving teams of analysts reviewing financial statements, customer data, competitive positioning, and operational benchmarks. AI due diligence platforms now compress significant portions of that analytical work from weeks to days. One platform, deployed by a mid-market PE firm in 2023, reduced their average due diligence timeline from 11 weeks to 72 hours for the analytical component. The human judgment layer remains, but the analytical support structure beneath it has been automated out of existence. The third threshold was operational playbook automation. The proprietary improvement frameworks that top PE firms spent decades building are now being systematically encoded into AI systems. Vista Equity Partners, which built one of the most sophisticated operational improvement capabilities in the industry, began deploying AI systems across its portfolio in 2022 to automate the application of its playbook at scale. The same interventions that previously required a team of operating partners to identify and implement manually are now being identified algorithmically and initiated automatically across the entire portfolio simultaneously. The human insight has been encoded. The machine executes it. What this means structurally is precise. The 3 advantages that justified private equity's fee structure, 2% management fee and 20% carried interest on returns, were always information advantages, dressed as skill advantages. The ability to find deals others could not find. The ability to analyze companies faster and more accurately than competitors. The ability to improve operational performance using proprietary benchmarks nobody else had access to. AI has made all 3 capabilities available outside the exclusive institutional context in which they previously lived. The moat was information. AI is water. Water finds every gap. The data is already showing the structural shift in real time. PE analyst headcount at major firms has declined 18% since 2022, as AI platforms absorb the workload that junior deal teams previously performed. New fund formation among traditional large-cap PE firms has slowed as institutional investors begin directing capital toward AI-native alternative asset managers that demonstrate lower operational costs and comparable return profiles. And a new category of operator has emerged: the AI-native private equity firm. Smaller teams, lower overhead, AI-augmented deal sourcing and diligence, and access to the same operational benchmark data that previously required decades to accumulate. Consider what this looks like in practice. Andreessen Horowitz has built one of the largest proprietary AI systems in the investment management industry, analyzing thousands of companies, markets, and operators simultaneously to surface investment opportunities at a speed no traditional analyst team can replicate. EQT, the European PE giant, has deployed AI portfolio monitoring systems that track the operational performance of every portfolio company in real time, flagging deviations from benchmark before a human operating partner would have identified them through quarterly reviews. The playbook is being automated across the entire industry simultaneously. The question is not whether this is happening. It is already happening. The implications extend beyond the PE industry itself. Because private equity owns a significant share of the operational infrastructure of the global economy, the software companies, the healthcare networks, the logistics systems, the AI-driven improvement in how those assets are managed flows through to every business and consumer that interacts with them. When PE-owned companies operate more efficiently because AI has optimized their performance, the operational improvement is not contained within the investment thesis. It propagates through supply chains, workforce structures, and pricing mechanisms of the broader economy. The PE industry's transformation is not a financial story. It is an economic architecture story. Now the opening. For 50 years, the private equity model was structurally inaccessible to anyone outside the institutional network. The minimum investment in a top PE fund was typically $10 million or more. The deal flow that generated the best returns was exclusively available to firms with established institutional relationships. The operational benchmarks that enabled value creation were proprietary to a handful of firms that had spent decades accumulating them. Three barriers defined the boundary between institutional and non-institutional participation in private equity economics. AI has not removed all three, but it has removed one entirely and significantly lowered the other two. The barrier removed entirely is operational intelligence. The proprietary benchmark data that KKR, Blackstone, and Vista spent decades accumulating is now functionally approximated by AI platforms trained on public and semi-public company data at a scale that produces comparable insights. A founder, operator, or small investor who deploys AI-driven operational analysis tools now has access to the kind of performance benchmarking that previously lived exclusively inside the largest PE firms. They can identify operational gaps in a business, benchmark its performance against comparable companies, and model the value creation potential of a specific intervention without a team of operating partners and without decades of institutional deal-making behind them. The barrier that has been significantly lowered is deal flow. AI deal sourcing platforms have made off-market acquisition opportunities visible to a much broader category of buyer than the traditional PE relationship network ever serviced. For search fund operators, independent sponsors, family offices, and small PE firms without the institutional brand of a KKR or Blackstone, AI sourcing tools have created access to deal flow that simply did not exist at this scale 5 years ago. The operators who build their investment and operational practices around the tools that lowered these barriers are not just accessing what was previously exclusive. They are operating with a structural advantage that compounds with every transaction they complete. Private equity did not build its empire because its practitioners were smarter than everyone else. It built its empire because it had access to information that everyone else did not. The benchmarks, the deal flow, the operational playbooks, these were never skills. They were databases. And databases, unlike skills, can be replicated. The most secretive industry in finance kept its secrets in filing cabinets, in relationship networks, and in the institutional memory of firms that spent decades earning the right to know what they knew. Those secrets are being encoded into systems, with no interest in keeping them exclusive. The playbook is out. The question is whether you understand it well enough to use it. That was it for today's video, and as always, the world keeps changing. Change itself is like a cloak sewn to the back of our existence. Subscribe so you always know what's changing and what to do about it. Take care, and I'll see you next week.